Hi everybody, Thomas Moore here at Rebel Income. It seems like the one stock that every market media channel wants to talk about every day is NVDA. For growth investors, this is a stock that has seemed bulletproof, rising from around $475 per share to start 2024 to hit one all-time high after another, and with the stock sitting at around $1,150 right now. That's an increase of more than 142% in just 5 months' time. Last week, the company made headlines yet again by announcing a 10-for-1 stock split, which is set to take effect on June 10th. That's got a lot of people, me included, considering the difference between buying the stock right now or waiting until after June 10th. The fact that current shareholders will receive 10 shares for every 1 share they own right now sounds interesting, especially if the stock follows the same pattern that it did in 2021. When the stock split 4-for-1. That split brought the stock down from about $700 per share to roughly $180, setting the stage for the upward trend that has the stock where it is now. The implication is that this latest split, which is expected to take the stock down to somewhere between $100 and $200 per share, will set the stage for another opportunity to buy the stock at a lower price and then watch it rally all over again. The real irony is that the best reason to think seriously about buying even just 1 or 2 shares of NVIDIA right now before the stock split has flown almost completely under the radar for most investors. To uncover and make sense of that reason, we need to evaluate the company's business and ask that eternal question. Is this a stock that is worth owning at its current price in the first place? NVIDIA Corporation provides graphics and computer and networking solutions in the United States, Taiwan, China, and internationally. While everything you hear about NVIDIA right now is all about artificial intelligence, this is a company that cut its teeth building graphic processors, or GPUs, for gaming systems. The power of those processors has found additional applications in cryptocurrency mining and the Internet of Things, giving the company the resources to keep innovating their processors, which now make up the backbone of the high-powered computing systems that make artificial intelligence useful in an increasing number of ways. The company's market cap is $2.82 trillion. Over the last 12 months, earnings increased by more than 559%, while sales grew more than 262%. In the last quarter, earnings were a little more than 18% higher, while sales increased by just a little under 18%. Growing earnings faster than sales is hard to do and generally isn't sustainable in the long term, but it can also be a positive mark of management's ability to maximize their business operations. The company operates with a margin profile that is among the largest in the semiconductor industry and is growing. Over the last 12 months, net income was 53% of revenues and increased in the last quarter to more than 57%. NVIDIA's free cash flow is impressive at more than $39.3 billion over the last 12 months. It also increased steadily in each quarter of the past year from a starting point at around $10.3 billion. NVIDIA's balance sheet is a significant source of additional strength, since cash and liquid assets were more than $31.4 billion versus long-term debt of $8.45 billion in the last quarter. Like many of the largest tech companies, NVIDIA pays a dividend, and this is where the real value of the stock split announcement comes through. While the company's dividend has barely been enough to call negligible, management also announced a 150% increase in their dividend payout following the split. With the current shares outstanding taken under consideration, that will increase the payout from just 16 cents to 40 cents per share per year. Raising the dividend will take about $540.4 million from their available cash, which is really just a drop in the bucket of the cash they have available. The important thing about the dividend increase isn't its size, at least not yet. Dividend payouts are a clear indication of management's commitment to return value to shareholders.
Increasing the dividend on even a modest basis is a signal that management is thinking ahead to the point in time when their current investments in building capacity to meet demand will taper and moderate and provide an even more attractive passive income opportunity for long-term investors who can increase the number of shares in their account by a factor of 10 by doing nothing more than owning their shares now. The caveat to this rosy picture is that it really only makes sense if the stock offers a useful value right now, with a reasonable expectation of price growth in the long term. There are a lot of ways to measure how much a stock should be worth, but I like to work with a combination of price to book and price to cash flow analysis. Together, these measurements provide a long-term fair value target at nearly $1,430 per share. That means the stock is surprisingly undervalued, with 25% upside from its current price. If you're bullish about NVIDIA and the likelihood the stock will continue its upward trend following the upcoming stock split, the increased dividend adds an extra incentive to get in at the early stage of management's commitment to its shareholders. The fact it also offers a useful value, even at its current price, is even more remarkable.
Thanks for your time. What do you think about NVIDIA? Add your comment below and let's compare notes. If you like this video, go ahead and give it a like. And help me grow my channel by hitting the subscribe button along with the bell so you get notifications every time I upload new content. If you want to leverage the power of my Rebel Income investing system with information you can use every day to turbocharge your investments, sign up for a free 7-day trial on my Patreon page. That link is in the description area of this video. Thanks again. I'm Thomas. Talk to you again soon.